The current backdrop of oil and the oil market, energy markets are such that the price has been under pressure for some time, and it's really because the market has been pricing in the idea that there's, number one, too much supply, with OPEC and OPEC Plus pumping more oil. And recently, the Middle East entered a world of heightened geopolitical risks. And when you get into heightened geopolitical environments, that tends to be positive for not only broad commodities, but specifically energy and oil prices.
Today, the war premium in the market is effectively zero. And so I think the question investors have to ask themselves is, given the geopolitics of the day, is that effectively a zero premium? Is that appropriate or not? And looking at how things are developing in Iran and how things are developing in Russia and the Ukraine, I would say that a healthy premium should probably be justified, just given the potential for outages in those countries.
Tensions in the Middle East rose after Israel and the US launched strikes on Iran, sending oil prices higher. Since Iran is one of the world's top oil producers, the attack sparked fears of supply issues. But those concerns eased quickly, and prices dropped again once it became clear that production and supply routes weren't affected.
I think the risks in the oil market are always and forever sort of black swan tail risks that no one sees coming. And that could be anything from really surprise OPEC increases to a global coordinated recession. But one thing that I do think underpins the oil market today is how little has been invested in the space over the last 15 years. And it means that our supply base is very, very fragile and is very susceptible to slowdowns.
Global oil consumption plummeted during the pandemic, but has recovered and stabilized more recently. As the US government is prioritizing carbon fuels over green energy, this sector is likely to keep growing.
They also want, just like any administration in history, they want low oil prices because that impacts consumption, that impacts how politicians are viewed in the polls. So that's going to be continually being a challenge. So we don't think that they will pump till the cows come home or drill baby drill because the economics aren't favoring that anymore. And so they've learned that, and we've already seen some energy companies come out and say, we will reduce the amount of production if the price drops below a certain level. And the low 60s is kind of there in terms of their profitability from that standpoint.
Oil prices are down about 20% year over year because more oil is being produced. This extra supply is pushing prices lower.
I really think the announcements coming from OPEC and the Trump tariffs have been putting a lot of downward pressure on the oil price. But I think that's mostly overdone. The only time it's been cheaper was really during COVID, when it obviously went negative. So apart from those periods, today crude oil has never been cheaper in real terms. Over the long run, what's an oil price that will incentivize enough new production to come online to meet demand growth? And that number is somewhere around $100 today. It's clearly not 50, 60, or even 70, because we saw a substantial slowdown in development in the US, in the shale, at those prices. And it's not enough to really incentivize large-scale deepwater offshore. OPEC and OPEC Plus decisions definitely rattle the market. It remains to be seen how many additional barrels they'll actually place into the market between now and year's end. More oil in the market, that should mean that prices move lower.
Certain market conditions could upset oil prices, like inflation and a global economic slowdown. But perhaps the most concerning issue is the aging US shale sector. Years of heavy production have drained many of these reserves, and that decline is expected to continue over the next decade.
The only source of non-OPEC supply growth has been the shales. That's now slowing. So I think that's going to be the biggest driver going forward. And you really can't overstate how important the shales have been, because in the last 15 years, all the world's oil supply growth has come from one source, and that's the shales. And in the last 10 or so years, it's really come from 6 counties in West Texas. And those areas in the Permian Basin, they're now beginning to show their signs of age. And what we've seen over and over and over again is that when non-OPEC oil supply growth begins to slow, prices move substantially higher.
So the world consumes about 102 million barrels per day plus, give or take. And so even if you have a couple 100,000 or 1 million barrels taken off the market, that doesn't sound like a lot, but because the price changes at the margin, at the incremental level, it can have a pretty significant impact to the price.